How's everybody doing this morning? Did you have a good weekend? I did. Didn't do a whole lot. Took some time off and enjoyed the quiet. All right, but we're ready to rock and roll today. We're starting off with what are we starting off with? We're starting off with the backbone of the financial market, which is the S&P 500. Actually, this is the Qs. And I got a lot of lines drawn on here, and I want to show you how I come to this. It's kind of a little lesson that's in the manual. Uh-oh, already starting off. Hold on a second. Losing my voice. All right, I got some good stuff for us today. I want to show you how I got to this point here and what these little numbers are and what all this, there's a lot, it's like you draw enough lines on the screen, Lan, you'll eventually hit one and you can say your system worked. Well, that's kind of what we're looking at here. A little too many lines, but I want to show you how we got here. Give you a little lesson in making Fibonacci projections. All right. Doesn't mean the market's going to go there. It's just these are our Fibonacci projections. And so you can use them as a cluster of numbers to try and figure out where possible important points of areas of support and resistance might be. All right. If you use too many of them, then it becomes, too many lines. Eventually you'll hit one. You can say, oh, leak, see how it worked. Don't do that. But I'm going to show you how I got to this point, and then you guys can decide which one of these lines and how you want to do this. We'll get rid of some of them. We'll end up with what we call a cone of probability. All right, so I'm going to teach you that. And then I also want to talk to you about our portfolios. We got 2 portfolios going right now. We got a few trades on. We have to go talk about our trades that we've got going on. And then, of course, we've also got our long-term investment portfolio. This one here, this is our what we call our UBI, Universal Basic Income, right? So I want to talk to you about this one in particular because I want to talk about our cash cows and our cash cow total infusion. So this is the initial deposit cash cow, and this is the total infusion cash cow. But as you all know, if we come back to one of these old ones, remember this is the first iteration of the spreadsheet. Looked like this. And I gave you this one. And then I went to the second iteration of the spreadsheet that looks like this. This is the second iteration, right? And this is the current one. This is the one that we're working on right now. But I've made some changes to mine. Actually, both of these are mine. This is my traditional IRA. This is my individual IRA. All right. So this is, or not individual. It's my individual account, not my IRA. This is my IRA. Of course, we got a Roth, a SEP, an SHS. We got my wife's 2 accounts. We got all kinds of accounts in here, but they're all still basically out on the old version. So I brought my accounts over to the new version. This is the traditional IRA, and this is real money. This is these are real money accounts. And then this is my individual trading account, which is again real money. This is my real money accounts. And then the reason I bring this up is because I've got another idea. I always say trade like a business, right? Think like a business. And I did that article. I did a lot of articles on that. But one of the articles in particular was about the steering wheel machine, right? And if you remember that one, if you don't remember that one, send me an email, LHTurner at Pitt News, or just, I think it's actually, just send it to magazine@pittnews.com. That's a good email address. That comes to me. Magazine@pittnews.com, and ask for it, and I'll send you a copy of that article. It's a really good article. You can also go out to Claire's podcast, and if you look through the history, there's one on there's a podcast that was done on the steering wheel. That's probably a better place to do it because it's nice and easy to listen to. So go listen to Claire's podcast. And if you're not subscribed to her podcast, it's free. You don't have to pay anything for it. Just go over to pittnews.com, click the button, sign up, go over there. It'll give you a list of all of her podcasts. There's one in there called Steering Wheels. Go listen to that. That's a really good one. It's talking about running your how you run your portfolio as a business. And I call it the UBI, Universal Basic Income. Everybody, I listened to a big long podcast yesterday. One of those kids out there that does that podcast talks for like 2.5, 3 hours. Who would ever do a video for 2 hours? We do them here all the time. I shouldn't say that. Anyway, he did this video. It was like 2 hours long talking about how the world's gonna end basically because of AI. And it's gonna be tumultuous, whatever that word is I'm looking for. It's gonna be tough. It's gonna be tough for the next 15 years, he said, and then it's gonna become utopia. So if you're gonna live longer than 15 years, you're gonna be here to see utopia, he says. All right. But through the next 15 years, it's going to be really hard because we're going to be making a transition out of the, I don't know, the type of economy we have now into a not like Star Trek, I guess. Right. So where everything's free, I guess. I don't know. It's all speculation, right? Nobody knows what's going to happen. But they seem to think that the world's going to have some tough times and then it's going to be really super good. So if you guys are young, look forward to the really super good stuff. But right now, for me, it's really super good. So I'm really super happy about the way things are turning out. I'm really liking things right now. You know, things are coming along. It's nice to have a little bit extra money from our UBI portfolio. That's a little grease of life. And money, that's all it is. If you think about it, it's just a little grease of life. It helps you grease your way through life a little bit better. And I want to help people do this. And I was telling my wife the other day, we were talking about it, and I was going down the street and I saw somebody who, you know, actually we were at the coffee shop and she loves coffee. My goodness, I married somebody that, you know, I grew up Mormon. And so coffee to me is like, nah, you know, it's like, we don't drink coffee. I don't know anything about coffee, whatever, you know, it's hot chocolate, I guess, with a little bit of flavor in it, different flavor. But anyway, she loves coffee. So coffee is like very important to her. And so we go to the coffee shop and we go down there and there's some people there at the coffee shop that we get to know, right? And I like them. They're nice people and they're poor. You know, they're young kids, not young, but you know, middle-aged young kids running the coffee shop and stuff. And we get to know them and we talk to them and they're friends. And I'm like, I was sitting there and I was telling her, I was like, man, I don't know what it is. I just want to tell everybody about how to trade in the stock market. I just want to take my friends aside. I did that the other day, and I just want to give them like $25,000 and put it into an account for them and say, look, if you just do this with it, you just have all this money coming into you every month, and you can just do whatever you want and make your life so much easier. And they're sitting there working for tips at the coffee shop, and they're really nice people, and I just want to help them so bad. And I just can't say anything to them, you know, because I can't do it for everybody. You know, I can't teach everybody how to make money. So anyway, I did it for my friends at high school. You know, we had do those seminars down at the ranch. And some of you have come to those ranch seminars, and I teach, you know, how to set up your accounts and what these accounts are and how to do it and how to do it the easiest way you can and all that kind of stuff. And there's a point to this conversation. I'm getting to it. But anyway, I just have this desire to help everybody. And, you know, I don't make money when you guys go invest in this and don't, you know, YouTube channels are free. Now, oh, you're making money on YouTube channel. Oh, come on. Okay, I'll tell you how much money a YouTube channel makes. If somebody has 1 million views, all right, they watch a channel for 1 million, watch that one, you know, that one video for 1 million times, they make about $30,000, which is pretty good for 1 million views. $30,000, a lot of money, right? But they have to have 1 million views. So if you take that down and you say, oh, well, Lan gets about 100 or 200 views on his videos, 100 people, 200 people maybe watch. All right. It's why bother. You know, they give me, I think every 3 months I get like $100. So it's not like I'm doing YouTube channel so I can be rich because I want to be a YouTube channel person, right? I do this as a lab for my university classes. And it's not like they pay, you know, my university classes are night classes. And so I just want you guys, I'm not doing this. I'm not helping you guys for the money. I mean, I don't make any money. What do I make money off of? A $39 a year subscription service to a magazine. Boy, we're rolling in the dough. I'm telling you. That's basically free. The only reason I put the $39 on there is so that we don't get a whole bunch of people from, you know, Venezuela signing up for it to try and get, you know, India and Pakistan people signing up for it just to see what, bots signing up for it. So we put a little barrier in there just to keep people out who aren't serious about what we're doing here. It's basically free. So we're not making a whole lot of money off of this thing. I'm just helping people, trying to help people. I made, look at this. Look at this. Come on. Come on. I made, last month, I made $30,000. That's $30,000 a month. I'm averaging, look at this. My average monthly income on this is $40,000 a month. I mean, it's more money than I know what to do with. I can't spend $40,000 a month. I'm just a simple little guy that lives in Logan, Utah, accidentally did something right. And so I want to kind of help people and show you how to do it. I mean, it took me, I'm a slow learner. It took me 20 years to be an overnight success, So I just like helping people, and that's all. And so the point that I'm coming back to is that I'm coming through a different iteration. All right. So I'm coming through a different iteration, and so here is the new version of my spreadsheet. The new version of this is the old version, and you can see that I'm making a new version. So this is the third iteration. So that was a long story getting to the different iteration. Now I spent a long time creating these spreadsheets. I mean, I spent hours and hours and hours. And as you can see, I make $50,000 a month. So my time is very valuable. Okay. So I want you to appreciate these spreadsheets. I'm just giving them to you for free. Anybody who subscribes to Pit News Magazines, which isn't free, $39 a year, you're going to get my spreadsheets. All right. So I've given you all these iterations of these different spreadsheets. And this is the new one. This is the new one that I'm working on right now. And what spurred this is, again, it comes back around to I was over at, well, do I want to mention the name of the website? I don't know if I want to mention the name of the website. Yeah, I'm not going to mention the name of the website. I was over at the website reading blog posts, right? Posts from people. And again, I came across another guy who was doing his math wrong. All right. And he made a comment, that just was wrong. And I'm just like, you're doing your math wrong. And I see it. It's so common out there of these people who don't know how to do their proper math. And I can't really come down on them too hard because the math is hard. I mean, the math that we do in there is, and it's not like it's not like you can just go to ChatGPT and say, how do I do the math for this? I mean, ChatGPT will help you, and I get ChatGPT to help me create these. But ChatGPT will, if you don't prompt it properly, it will tell you to do the math that you ask it to do, which if you ask it to do the math wrong, it will help you very perfectly do the math wrong. And that's what's happening to these guys. I went out and was reading this article, and I was like, obviously, this was written by ChatGPT. The guy had written it. I mean, it had all the phraseology. It had everything that ChatGPT tells me when I use it. It said all the same stuff ChatGPT tells you. When you prompt it to do the wrong thing, it will help you do the wrong thing. And so you got to be very careful. If you don't know and understand the math and the concepts behind financial entertainment here, I mean, the financial markets, it will sit there and tell you exactly how to do the math wrong because that's what you asked it to do. How do I do this? And it'll say, do it like that. Just this is how you do the math that you asked me to do. And it's not going to say, oh, by the way, you're doing the math wrong. No, ChatGPT doesn't do that. It goes and says, oh, you want to do this math? Here's how you do it. And it's not going to come in and say, but oh, by the way, that's not how you're supposed to do it. Now, if you ask it if that's how you're supposed to do it, it will tell you. It'll say, these are practices that you can do. This is best practice. And then you say, well, what about this issue? And it'll come out and say, oh, that's a real world issue that lots of people run into. And this is how it's generally solved. And, you got to go into it a little bit deeper. You can't just go in and say, write me a blog post on this, because it will, and it'll all be wrong. And I've seen it so many times. So the point that I'm trying to make here is that I want to kind of simplify it once again. I'm going through iterations of my own spreadsheets. And so I've got the old spreadsheets like this, I've gone to the second version, which is this one here, which is much better. But this one doesn't give you, I mean, I just copy and paste the data out of this one into this one, but I do the, it's a different concept. It's a different concept. All right. So I use different names. Like I have CapEx, CAV, I have CapEx, cumulative rev remaining. I have my ROC. You notice in here, I've got no place where I say cash cow. This is my cash cow. I just renamed it ROC, right? Return of capital. So I want to start thinking and helping people understand, because I oftentimes talk about in the financial markets, it's like a sandbox. And you've heard me say this before. The sandbox is you have three basic different models that you can build, financial models that we can, now there's more than that, obviously, but the three primary models that you build out in the real world, right, out in the physical world, are these three sandbox setups. So one is the flipper, right? You go buy a house or you go buy a product or a service, and then you sell it for more than it cost you. So that's the flipper mentality, right? You go in and you create a widget, and it's really cool, and you got this really cool widget, and it cost you $1 to make, so then you sell it for $2, and that's your profit. That's the flipper mentality. You can do that in real estate, and of course you buy a house and you fix it up, or you hold on to it and you sell it a couple of years later, and you buy it for 100,000, you sell it for 120,000, you made 20 grand, right? That's the flipper mentality. And that's very common. In fact, it's the most common way of doing things in the stock market. People think that that's how you trade the stock market. You go in, you buy it, and you hold it, and you sell it later for a higher price, right? So that's the flipper mentality. Now, however long you hold it is, in different realms. You have people who will hold, like Paul Golden will hold it for about 8 seconds. All right. And then there's people who will hold it their whole life, right? And then just try to sell it at the end of their life. So there's lots of different ways to trade the flipper mentality, but it's still the flipper mentality. That's what it is. And then the second model is the old version of dividends, right? Or I guess I don't want to call it the old version because it's current. It's what a lot of people do. They buy and look for the dividends to pay off. Now, the problem with the old version of dividends is that they've been so small that you needed such an enormous amount of capital to make it worthwhile. It's what I call the why bother dividends, right? They're so the dividends are so small, the market will move one day and wipe out everything that's in your dividend. It's the net asset value of the moving market can outperform the little puny dividends that you have to have. Basically, we've always said, my whole life, we've always said you have to have about $2 million to retire, so that you can basically live off the dividends, right, that are being produced, and make about, $30, $40, $50,000 a year, $100,000 a year on those dividends. And so, and then people are like, $2 million, I got to save $2 million. And it's pretty much out of reach for most people. They go in and put their money and save their whole lives in a 401k or something. And at the end of their lives, they have $300,000. And it's like, well, I'm kind of, a long ways away from 2 million. And so that kind of mentality is more like the rental property, right? You go out and you rent property, you buy a house, and then you live off the rent. And that's okay. Lots of people buy houses and live off the rent. And so in the stock market, you can take that same concept, and that's another concept. You buy the house, which is the stock, and you live off of the dividends or the rent. Well, in the business model, we go into, a much more aggressive model. So we go much more, it's very similar to that model, but we go into a different style of compounding. And that's the thing that really gets going. Now, I know compounding is a thing in the stock market, and everybody's trying to compound. But when you just buy and do the flipper, you're not compounding. There's no compounding there. Kind of, you can say, well, but you got to buy and sell to compound along the way. You got to, buy low, sell high, buy more, buy low, sell high. You got to actually trade. You can't just buy something and hold on to it. And then when you're old, say, well, I compounded my whole life away. No, you didn't. That's like the 401k that you've been putting money into your whole life. And at the end of your life, you got $300,000. You didn't compound anything. That's linear growth, right? You buy a share of stock, and You hold on to it for 30 years. At the end of 30 years, you still have one share of stock. Now that one share of stock might have gone from $10 to $300, and you made a big amount of money on it, right? But over 30 years, was that a big lot amount of money? Probably not. Maybe, I don't know, maybe a little bit, but that's the reason why a 401k never, if you don't actively trade it and do things with it more than just stick your money in there and hold it for 30 years, you end up with $30,000 $300,000 at the end of your life and not 3 million, because it's linear growth. You bought a share of stock and you only have one. And at the end of your life, or you buy, let's do more than one, because you're going to probably buy more than one share of stock, right? So let's say you bought 10 shares of stock, but every month you buy 10 more shares of stock, but it's all from money that you go out and work at McDonald's. So you work your whole freaking life away so that you can buy 10 shares of stock every month. And at the end of the year, that you still only got 10 shares of stock. No, I don't, Lynn. I collected all that. Yes, you did. That's called linear growth. So you end up with 10 shares of stock, and at the end of your life, you still have 10 shares of stock. It just increased in value, and you've just bought a whole bunch more stock. You haven't compounded anything. That's why your 401k doesn't turn into millions and millions of dollars, right? At the end of your life, you got 300,000, and that's it, because you didn't actively compound it. But Lan, I was putting it into stocks that have dividends and they're compounding. Yes, they are. With why bother money? Okay, it's like they're so tiny that it doesn't do you a whole lot of good. Not that it doesn't do you a whole lot of good, it does, and it's the way we've done it for years and years and years. The point I'm saying is times have changed. All right, and so we've got these more aggressive funds that have a higher degree of potential in them, and we can run them. The third model is like a business. All right. So we have a sandbox, and in the financial world, the stock market is a sandbox. There's not just the flipper mentality. You don't just buy them and hold them and sell them, or buy them and sell them, buy them and sell them. And there's not just the dividend mentality, which most people kind of ignore because it's such a small amount of money and they don't see it it takes a very long amount of time to do these little tiny puny dividends to make them worthwhile. And you have to have such an enormous amount of money. So in the old world of stock trading, you had to buy and sell, 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 buy and sell. Most people don't want to do that. They want to buy and hold, buy and hold, buy and hold, buy and hold. Buy and hold doesn't make you rich. All right. So you have to buy and sell, buy and sell, buy and sell. And then you have to buy and sell, buy and sell, buy and sell, buy and sell, and get more shares. And then those more shares will give you the dividends, even though they're little why bother dividends, after a long period of time. Because remember, you get your dividends based on the number of shares you have. And if you're not buying and selling, buying and selling, buying and selling, buy low, sell high, buy, sell, and generating more shares, your dividends don't ever increase. All right. So you don't have very many shares at the end of your life. And so that's why you can't live off the dividends, because you haven't produced more shares. You got to have more shares. Well, I bought more shares along the way, Lan. Yes, you did, but it wasn't enough. This is the point I'm trying to make. You got to actively be working at the system to get more shares so you can get bigger dividends. Well, it doesn't change that when we come over to these new funds that we've got the ability to compound our growth based on options. Now, it's a little bit more aggressive, and a lot of people are like, well, it's too aggressive for me. I don't want to do it. Okay, well, don't do it then. I'm not saying you have to. I'm just saying this is something that's available for you. It's the third rung on the sandbox. So you got the flipper mentality, you got the rental mentality, you got the businessman mentality. And I want to run as a business. I want to think about our portfolio as a business. And this is where the people who you go out on YouTube or go out on these different forums, they can't make that leap from these two over to this one. And so they do their math wrong. And so they don't understand the concept of a businessman. They're stuck in they're armchair analysts. They just don't know the math, first of all. And so they rely on ChatGPT to tell them the math. But the problem is ChatGPT is not going to tell you the math if you don't know the math to ask them. Okay. So it's not that you can't learn. You certainly can, but you have to learn and understand and talk to people who know, and you have to work it out, and you have to come to places that know a little bit more than maybe somebody else. And that's all I have to say about that, I guess. 3 mentalities. This is my new spreadsheet, and I'm working it up so that you guys can see more, even using business terminology. And I think that's more of what I'm doing than anything else is trying to explain and understand business terminology in a business world, from a business uh, manufacturing standpoint, and produce that over in the stock market so that you can see how to think like a businessman in the stock market. And I think if you do that, you can make more money because you understand a different form of math. And that's what it really comes down to. It's understanding a different form of math. And many of you are already business people. You already come from the business world. I know a lot of guys in our classes who have businesses or formerly had businesses. And I want you to take that business knowledge that you've got, and I want you to use that knowledge to create a model of your business in the stock market. You can do that. You can say, this is how I did it when I had my business, and I'm going to create that in the stock market, and I'm going to create a spreadsheet that runs my stock account as if it were my business. And if you'll do that with these yield max funds and these high return funds, the yield boost funds, and there's others. Those are just the two that we've kind of focused on. There's others, JEPI, JEPQ, some of these others that are still have the high returns. If you think about them in these different ways, you can understand what's going on and why you can have something like, 176% return. And some people look at that and they're like, that's not 176% return. They think the way they're doing their math, it's like a 5% return or a 10% return. And they're like, it's not worth it. Even 10% return. Look at this one here. I've got calculated at 15, which I want to show you. That's not exactly what that is. I want to show you how this works, because you have blended money. Remember, we've talked about that before too, because you have the money you put in, and then you have the money that it's generating, and you're putting that money back in, and that's where they get screwed up. They start counting money that the machine has already made as starting capital. Now, you can do that, and we do that over here, and I'll show you on this one. I have two numbers. I have the total infusion cash cow, and I have the initial deposit cash cow. And you calculate those separately because one is blended money and one is not. And so you want to know the two, one against the other. But this model here is a lot more fun because it kind of breaks it down. You can see how I'm doing it all in columns that are intertwined, whereas this one is kind of broken out. And so that's kind of the difference. But I was going to save this till later, but I just kind of got going, so I figured I'd just continue and let you see. But like this one for here, example, IRR, let me show you. IRR stands for internal rate of return. All right, that's your internal rate of return. So it's the true annual rate you earn considering the timing of every dollar in and out. If your machine completely stops working and its value drops to zero at the payday, at the payback point, IRR tells you the effectiveness annual rate of return over that period. So how many of you, when you're in business, you bought a piece of equipment that you would run and it would make you money? It would make something. All right. In my example, it was CDs, right? Because I was in the software industry, so we had to do physical CDs. And so my machines, I'd buy all these machines. I had a whole room full of these little machines that would burn CDs. I had floppy disks too. I'm that old, where we had all these machines that you'd put the floppy disks in, and it would kick out a floppy disk every few seconds. It would burn floppy disks. Remember when we had to do it manually, you'd put it in your computer and copy one to the other. Well, we'd copy software, but we had these big machines. They had big arms on them that would come out, and we'd stack these floppy disks in there, and then it would copy the software, copy track and trade onto this floppy disk, and then it would drop down and put it into another hopper. And we'd be running all these machines because we were giving out demo accounts, right? Free demo accounts to the software, and that's how you had to do it. You couldn't do it over the internet. That capability wasn't around when we first started. So we were doing CDs and burning floppy disks, and those machines would have a cost to them. And then we would have the software would have to pay for those machines, right? Well, how long would those machines last? Would they make us money longer than what they were paid for? And that's the whole thing. You have to pay for the machines, and then everything after the machine is paid for is your profit. Well, if you think about that in the stock market, people don't think about it that way. So you put in your initial investment into a market the money that you got from your, your investor, or from working at McDonald's, is what I oftentimes say, or pumping gas, right? You go out and work at McDonald's and get some money, you put it into the stock market, and then that money makes money. Now, if you just do it linear, you take that money and you buy shares and you just hold on to it, and then those share values should go up over a long period of time. But if you can make that money generate income for you, which is what these high income markets do, is that they generate money for you. Once that machine is paid off, right, that initial amount is paid off, all the money that comes back into it is called blended money, right? It's money that's, you didn't have to go work at McDonald's to make. This is where you end up with compounding interest, right? This is how you compound your business. This is why businesses are so expensive and so valuable, is because they compound the initial investment. Well, you do the same thing in the stock market, so you don't have to go out and hire employees and do all that stuff and be an actual capitalist. That's why those of us who do it in the financial markets, we're called capitalist bastards, right? Because we do the same thing. We just don't have to employ anybody. We don't have to do any of the work that you would have to do to run a real business. You don't have to go buy a business building. You don't have to go and hire employees. You don't have to get telephones, and you don't have to do marketing, and you don't have to do all that stuff. So you don't have all that overhead. Yet you can build the same model in the financial market, run the business in the financial markets, because it's a sandbox and you can structure it however you want. And you can build that model in there without having to have all the employees, the phones, and the buildings, and all the overhead. And you can still make that kind of money. You put your initial investment in. Once that's paid for, the business keeps making money. That's your return on money. That's your compounding. And that's the problem that these guys are doing, that they're not taking that into consideration. They don't understand it from a business mindset. So you guys who have been in business are already miles ahead of those guys who have not been in business and don't understand business math. So if you apply business math to the financial markets, you're going to see a whole new world that opens up to you, and an understanding that these guys never will understand, because they just don't have the knowledge. All right. So that's the point I'm trying to make. So that's what this model that I'm building now, not that this model isn't doing that, it's doing it. It's basically the same concept. It's just that I wanted to think about it even more like how we run our businesses. All right. So each one of these, you can think of each one of these funds as an individual machine within our overall business. So if we own PLTY, for example, Palantir, the Palantir stock symbol. Now, we're not talking about the Palantir, the stock symbol. We're talking about PLTY, the dividend version of it. All right, because the dividend version actually does something to make money off of the stock version. All right, so there's a process that's being taken care of. There's a manufacturing process, which is done with options, right? Of course, going down the road of how they do this, they do it with options, right? So options premium, and they make premium, and so they're making a product, basically a service, right? So they're providing a service that then turns into an income, which then gets put back into the business. Now, if we put it back into the business, we can put it back into the business model, or we can put it back into buying more machines, right? And when you do that, that's your blended money. That's your compounding, because you're not going out and working at McDonald's for every single thing you get like you do in a 401k. You're making your machine buy new machines. And when you can make your machine buy new machines, and not you buy new machines or buy new shares, you're not the one that's going and working at McDonald's to make the shares. You're making your money work for you. So your money is actually buying more machines. That's where you get compounding, and that's where you get true wealth. All right. So I just kind of want to teach this to people. And I'm like, come on, people. And just to weave this back to the beginning, where I was watching this podcast where this guy was talking for 2 hours about how the world is going to go through a real tumultuous time frame for the next 15 years or 10 years, is that we work out how people are going to lose their jobs with AI. AI is going to take everybody's jobs, and they're not going to have money. And they keep talking about how the government's going to have to give everybody money. And I just want to slap my forehead. I can't do it because I have a hat on. I slap my forehead. Go, you guys, the government's form of UBI, universal basic income, is Social Security. And how's that worked out for us? Social Security is not the answer. You're not going to give the whole world Social Security. Stop with the going and running to the why is it? Why is it that the youth nowadays, the kids, every answer is run to the government? The government will do it. The government will solve the problem. The government will give us money. The government will take care of us. The government, that's a socialist society that runs to the government. That's what Russia does. That's what China does. That's what North Korea does. Run to the government. The government will save us. The government knows everything. The government is the best thing in the whole world. That's what, don't do, why? I remember growing up as kids, and it was like the government was supposed to be small and little and stay out of your lives. Let you do what you want. You don't turn to the government every time you need something. You turn to your friends, your family, your church, your religion, your community. You help each other, and you grow, and you do things yourself, and you try, and the last place you ever turn for help is the government. That was the way I was raised. I don't know about you guys. Of course, I was raised up in a very communal organization. I was raised as a Mormon in Utah, and so, I was raised by a father who had 5 businesses, 10 businesses. I mean, I only had 3, and so I was kind of a disappointment in my family. So so anyway, it's just a different mentality. So all these guys, these young kids on this podcast, run to the government. The government's going to save us. We've got to have the government do this and the government do that. And the government's got to give us all money. And the government's, oh my gosh, I'm just like, there's a capital markets for a reason. This is a country that was built on the backs of people who work and create money, and a capitalist society. And the stock market is the provincial world of capitalism, right? I mean, the capital markets. That's why we call them capital markets and the capitalism. It's because business is way more important than government. Government is supposed to be very small and do its one little job of protecting our borders, right? And that's really all it's supposed to do. It's not supposed to tax the people. Taxes on people, that's a relatively new thing. Trump's kind of bringing that to the forefront, saying, look, we didn't used to be taxed. That was a new thing. They're just recently, in the last 130 years or something, did we tax the American people. All the taxes came from taxing foreign countries who wanted to sell to us, the tariffs and stuff. He's reminding us how this country was supposed to have been built in the first place, of being able to have an economic backbone based on capitalism. Now I call, you heard me, I call it, I call what I do, capitalist bastard, because I did though, I did go out and run a business, and I had employees, and for 25 years I ran my businesses, right? So, and I still have Pit News Magazine. That's a business, right? And it's not as big as my other businesses were, but those are real businesses. And so that's real capitalism. And I was raised on capitalism, right? That was the whole world that we worked around, is building businesses and employing and hiring people, making jobs for people. Now you come and reproduce that in the stock market, and if that's the only thing you do, yeah, that's why we're capitalist bastards, because we come in and we don't actually hire anybody, but we make the money. We make the money off the backs of the people who do. So, it's okay. It's all a circle, right? I mean, we provide the investment income for these other companies. We give Palantir our money. They can then hire more people, and they can grow people. And then, of course, we get money for that. We get paid for that. So still capitalism, just the bastard side. All right. That's just my own fun little take on it. Anyway, this is the stock market, and this is the way I want us to think about it. And this is what I'm teaching. So I don't teach a lot of flipper stuff. Now we do, because how else is another way of getting money to put it into these types of markets, into our business? Well, we can go trade. And so that's where we come back over to this market here. And then we become traders, right? And we become traders for the purpose of generating income, money that we can then put into our business. All right. That's our capital growth. Now, if you're not good at trading, and you can't make money trading, then you're going to have to go work. Who wants to do that? So then you have to go get a job. right? Be an engineer, be a doctor, grind on people's teeth, fix broken bones, whatever it is you do to make money, pump gas. That's what I did, right? So whatever you do to make money so that you can put it into your business, which is actually a capitalist bastard business in this case, which is not hiring people, but actually just building a model of it in our sandbox that produces the same types of income. All right. Now, I want to go back and mention one more thought that I had on that, because I want to take the brains of you guys who have been in business, and I want you to think about your business for a minute. And I want you to think about when you make a product and you sell it, how much money was a good return for you? Think about your business. How much money was a good return for you? Now, when we sold our software, we had, because you think of cost of goods sold, right? So if you're in a business where you have a cost of goods sold, like you have a retail store, all right, or you sell cars for a living, you have a car, that car costs you $10,000 and you sell it for how much? How much? Some of you guys know. You're like, oh, we got to have 20%. Sometimes we work on very thin margins because we are in a place that has a lot of competition. So we're lucky if we can get 10 or 15%. So your business at the end of the year, how much money, how much revenue were you able to generate? Okay. So you have the amount of money, your gross and your net. So the gross amount of money is, well, I sold a $10,000 car that cost me $10,000. So I have gross revenues of $10,000, but you didn't make any money. So if you sell it for $2,000 more than you bought it for, so you sell it for $12,000, you now have a 20% net, right? You have $2,000 against your $10,000. And a lot of guys would be like, well, I would be lucky if I could sell a car for that I bought for $10,000 and make $2,000. That's 20% net. That's a 20% income. That would be your IRR right here, would be 20%. A lot of guys in business would be very happy with that. Now, my business was software. So you're like, well, you sold your software and you sold it on a CD, and that CD cost you 99 cents and you sold it for $200. So you're really making a lot of money. Well, I had a heavy overhead. So I have to count my overhead, my employees, my software engineers who write the software, as my cost of goods. Right now, when you have a car business, you have your cost of goods, which is the physical car that you have to buy, but you also have employees, and you have people who fix cars, and you have people who sell cars, and your salespeople, and you have the same type of thing that you have to have that comes out of that 20-30%. So if you're selling it for 30%, some of you might be saying, well, I have to have 30-40% to cover my overhead and give me some profit. And how much profit did you generally walk away with? How much were you happy with at the end of the month after everything was all paid for? How much money did you get? How much went into your pocket? How much did the company make? And a lot of guys will be like, well, after everything's paid for, and I've been running my business and working so hard, 12 hours a day, all my employees cranking away, and we're all working this big company and everything. We're lucky if we can make 10%. 12% is like really good. Some industries can go as high as 20%. So the question is, can you produce 10, 15, 20%, 30%? Let's really get high and say some of these guys are making 35% on their business, working 12 hours a day, running a whole complex and buildings and employees and phones and all this stuff, everything they have to do to generate that 25, 30%. And then I tell people, I was like, look, I can generate 175% return or a 43% return, or in this case, a 14%, which isn't a real number. I wanted to show you how that got to that number. And then, or a 71% return using the exact same mathematical style modeling in the stock market. And I can produce these types of returns: 71%, 43%, 175%. There's some of your machines, some of your little businesses can really make a lot of money if you do it right? And if you're running things very efficiently. And some make less money. But then you end up with, well, I run this machine and it made me a bunch of money, and then I bought another machine with the money that I made. Well, that's different money. right? I mean, that's not money you went out and worked for at McDonald's. That's money that one of your machines made, and you turn around and bought another machine with that money. So it becomes ridiculous amounts of money. All right. So if we come in here and we adjust this formula and see how I'm calculating these first two columns right here, 10,500 and 40,000. Well, that's not really true. 10,500 is money that I brought in for this machine from maybe McDonald's. That 40,000 is money I took out of other machines and put in here. So frankly, I shouldn't really be counting that because that's not money. So if I take that number off, see that L7 right there? If I take that number off, that's my true return, and it just becomes ridiculous. All right. So if I tell somebody that I made 451% return on my money, they're going to tell me I'm full of poop, right? There's no way. But yeah, that's a real number, because that $40,000 that I've used to buy the machine with didn't come from me going down the street and working for McDonald's. It came from me running another machine that made money, and I took that money and bought another machine. That's called compounding. And with these machines, they compound really fast when we're using these yield max funds and these yield boost funds. They can compound really fast, and so you can make a chunk of money and go buy another machine with it, or another share of stock from another different share of stock. And then that money's not considered part of the same capital. It's not the initial investment capital. So when you calculate that as two separate numbers, that's why over here in the in this one, I've got a cash cow initial deposit and a cash cow total infusion. Two separate numbers. This is how much money I brought to the table. I brought $476,680. That's how much I went out and worked. Not at McDonald's, but I worked at my business and saved that money from my business, making, the 10, 20, 30% a year. And I saved that money up, and that was money I had that I hadn't spent, and it was sitting in my savings account, and I grabbed some of it out and I stuck it in here, and I said, let's test this little, I wanted $500,000. And that's, to test these funds out and run these models on them. And so that money, that 476,000, I then came in and have received 278,000 in dividends. So if you count that out and figure it out, well, that's a pretty good return. And then you have your total infusion. I took that 278, turned around and put it back in. So I put in a total infusion of $876,000. This plus this equals this. And so my total reinvested is $400,000. So I have $121,000 of blended income, right? Where I've got my money that I brought in, plus I have money that got blended. That's what I'm trying to do here. I'm trying to figure out where all this money's coming from that I'm making this money from. And so then I have money that I'm doing trades on. So I have $7,000 coming in from options that I'm trading. That's my own income now. That's my income source because I trade. And then I have cash withdrawals. I've taken $107,000 out of my business and paid myself. So I've got to count that. And I've got $20,000 sitting in cash right now, waiting to be redistributed, either taken out, go spend it, buy some candy and toys, or to put it back in and build another machine, make more money, have more blended money. And so that ends up with a trading account current value of this much. These are my machines are worth this much. I paid this much for them, 476,000. They're currently worth 668,000. But that's not the money I made. That's just the money of the value of the machine that I bought. The machines don't generally in business don't go up in value, right? In the stock market, they can if you trade properly. Now, a lot of these funds will not go up in value because they're taking the profits out of them all the time. So the machines don't increase in value, right? Or even sometimes they'll go down in value. And that's okay. That's what happens in business. If you understand it from a business mathematical modeling standpoint, you know that when you buy equipment, it's going to eventually wear out and stop making you money, and you're going to have to pay for it again. So you have to take that into consideration on your trading. So that's what this is. And then so we have the trading account total values worth 803,000. Now, when I take all that math, it comes out and says in the last 12 months, I've made $326,000. That's a lot of money for a little business that I started with $476,000. Now, again, I'm going to come back to you guys who started your businesses and have businesses. That's a big return. That's a 69% annual return on my money. Okay. 69% return on my business. Now, most businesses, that would be dreamland, right? To be able to make a 69% return on your money, right? That's the whole business combined, because I got some businesses that made more money. I got some businesses that made less money. And it all depends on how I calculate my total return. Am I calculating it on just the initial investment? Am I calculating it on the total return? Am I calculating? And if I take all the blended money, all the money that my machine made, and I calculate it as if it's initial deposit, then my machine will only show that I made like 5 or 6%. But if I take that compounding money and say that that's not my initial investment, which is not what you're supposed to do, because it's not, right? It's not initial investment. It's reinvested money that your machine already made. It's like free money. Okay. Not that it's free, because time is value, but it's like free money. It's not money I had to go work for. I didn't have to go out to McDonald's and get it. So I don't count it as that McDonald's money. My business is operating and making money based on my initial investment. When I put in $476,000, how much is my business made on that $476,000? Well, it's made $326,000 this year on my $476,000. I will break even in 5 months. In 5 months, my business will have returned to me 100% of my initial investment, my $476,000. That's what that tells me. And in 8 months, it will have paid back everything I've put into it, the total infusion. Now, that number will continue to go out, push out into the future, because I will keep taking and putting more money in. And as I add more money in that I make, not from me, not from my McDonald's money, but if I put that back in, it will push that number out, because it has to make up that money. So that number keeps growing and going further out as long as I keep putting money in. If I stop putting money in, that number will stop growing. But we don't want to ever stop our business from growing, right? We want to continue growing our business, because our business, technically speaking, can wear out, right? So especially with these yield max funds, that's why people complain, oh, the NAV's going down. Well, that's okay. It's wearing out the machine. You buy more machine if you need to. The machines are actually doing pretty well right now. The stock market's going up. The machines aren't losing value. They're going up. If the stock market starts to go down, well, your machines will start to lose value. Okay. Doesn't mean they're going to stop producing. They might not produce as much. They're getting old, right? So you might have to buy some more machine to keep those returns coming in. It's like a business. You have to think about it like a business. But just because you paid off the machine doesn't mean the machine's going to stop working. That's the other point I wanted to make, is that if you come back over here to this number, and that's why I call it IRR, and if you come in here and look at the definition of IRR, if the machine completely stopped working and its value drops to 0 at the payback point, IRR tells you the effective annual rate of return over that period. All right. If the machine completely stops working, but the machines don't completely stop working just because you paid them off. You made enough money to pay off your machine. Now you're happy. Now you're like, now I'm, making money because I don't have to pay off my machine. Now I know I might have to buy a new machine later, but in the meantime, I got a machine that's still making me money, and it's paid off and it's still making me money. So if the machine keeps running, or if you still have value left in the machine and it's still producing income, or in an ETF that continues to pay dividends after the payback date, IRR becomes less relevant. An average return or ongoing yield becomes a better measure of performance. That's when you become a cash cow, no out-of-pocket risk. All right. So there's different ways of calculating your returns based on what type of money that you have that your machine was purchased with. Now, most of our machines are purchased with blended money. I put in 10% or 50%, and then I got 50% from the value of another machine, and I blended those together and I bought a machine. So calculating those returns becomes very difficult. But it's much more profitable to do it that way, right? And your returns become compounded by doing that. You have machines that you can buy with 100% of your capital growth without having to be part of the money you went to McDonald's to earn. So you calculate those numbers differently than you do the ones that you had to pay for yourself. And once the machine is paid for, it's all blended money and it's all free money, and it's all the percentage of returns are much higher, which is why you have to calculate those. And that's what these kids on the internet are not doing. They're calculating it wrong. They're not taking that into consideration. I want you guys to take that into consideration. All right. You need to take that into consideration when you do your math. Now, I'm going to give you this spreadsheet. When I got it done, it's still got bugs in it. Some of this math isn't the way I want it. And the problem is that I have blended money and I want to calculate, I want to break those two apart. And as you saw, when I have this one here, it goes all the way up to 451% if I take out that $40,000, which, you know, it makes it really tough to say, well, Lan, you're making 450%. Well, it is what it is, but there's really a cost of business of that 40,000 in there, but it was blended money. So if I put that back in there and it's L7, if I add that blended money back in, my IRR goes all the way down to 15%, which is, you know, you say, well, that's more realistic, 15%, but it's not, because that 40,000 came from another machine that made $40,000 for me. I didn't go out to McDonald's and work and make that 40,000. So technically speaking, I shouldn't include that in my formula. That's free money. That was money that was, so if I'm making money on free money, that's the compounding effect of going from counting it. This is what they're doing on the YouTubes. All right. And I'm going to add in the next one because that's what they're doing. They're doing L8. So they're adding in L8 as well. All right. So here is what the guys on the YouTubes and on the forums are telling you you're making with your yield max funds, 11%. And that's why they come up with these stupid statements like, well, that's sure a lot of work for a lot of complexity for not much more than what you can make in a, you know, in a bond fund. And that's what the guy was saying. Oh, you can make that in a bond. I'm like, dude, if I can make that kind of money in a bond, tell me the bond, because I'd be all over that bond. I'm telling you, 11% is a lot of money. A lot of retail companies, coffee shop is lucky probably if they can make 11%, right? They'd be happy. All their bills are paid and the owner gets to walk away with 11%. He'd probably be dancing in his shorts. And here I am coming in here and saying, well, that was free money that was given to me that I'm making all this money off of. I shouldn't have to count it. You're right. You shouldn't have to count it. So take it out. Boom, 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 boom. And then you're like, well, that's 451% return on your money. Well, I'm sorry, you made a shit ton of money. Well, it can't be realistic. Nobody makes 451% return on their money. Well, you're making money off of free money. That's the magic of this thing. That's what I want to tell people. That's why I go to the coffee shop and I want to just take these little guys that are in there, and these little girls and guys and gals and people that are in these little shops, and I'm going to say, look, I can show you something really cool. I can show you how to make 451%. Now, it's not going to happen overnight. You got to have some free money come in so you can make some free money, but you got to make your free money, make free money. And if you can't wait for your free money to make free money, it's not going to happen. But if you can just get started, I can help you make a lot of money. And people are out there like, oh, it's not, I can make that in a bond. I can make that in a government bond. The government will give me that much money in a bond. I'm just going to give my money to the government. You can't get that kind of money from a government bond. Give me a break. All right. Have I spent an hour telling you people aren't doing their math right? Just a little pet peeve of mine. I hope it helped you understand something. I promised you I was going to show you how to do a delta Kona probability. All right, let's do the delta Kona probability and we'll let you go. So this is the delta Kona probability. This is being done on the S&P 500, which of course is the backbone of our of our money, right? Backbone of the financial market. So let's delete all of the delta, all these lines, and let's just look at this market. So where are we at in this market? This is actually the Qs. I would rather do it on the S&P because the S&P is actually the backbone, not the Qs. The Qs kind of backbone. That's the backbone of the let's give it a little bit bigger screen here. We're not working with options. We don't need that. All right. So this is the backbone of the financial markets, the S&P 500. This is SPY. It's just an ETF, an exchange traded fund of the S&P 500. All right. And so we've got this one, and this is the last big run that we see in the markets. And you can see that it's drive 1, drive 2, drive 3. So we're in the third drive, and we're expecting this break. Everybody's freaking out because the market's coming down, and they got blame everybody. They got to blame Trump and all of his tariffs and everything. There's, the whole world is falling apart because we're getting a little pullback in the stock market. All right. And they're all blaming everybody. The mainstream media is just an absolute joke. Please don't listen to those guys. Again, another article that you should read. You go out, and again, Claire did a video, not a video, a podcast on it. And if you go out to her podcast, in fact, I'll show you. Look, it's real simple. Which one you should watch. I'm going to show you a couple that you should watch. Let's come in here, and we're going to go over to Pitt News Magazine. All right, pittnews.com. Just come here. There's Claire. Click on her little podcast button right here. Click here. It's going to bring you over to, let's see, I don't know what, allow Spotify to open. Yeah, open the link. Okay, and so this is the Pitt News on air thing. All right, so if you slide down here, how do I see all of them? Load more episodes. All right, so where's the ones I want you to watch? I want you to watch all of them. I mean, listen to all of them. They're not watch, they're listen. So let's see. The ones I want you to listen to in particular, this one right here, Think Like a Business Owner. All right, Think Like a Business Owner. So I want you to listen to that one. That's a real important one. And then I want you to listen to this one. This was a really good one. It's our very first one, BlackRock Algorithm Unmasking Aladdin. That's a really good one. But then this is the one, The Truth Behind Markets Moves. It's not the news. All right. So I want you to watch that one. Take that one to heart. In fact, you should listen to that one once a week. This one is really important for you to know too. So if you haven't listened to the BlackRock Algorithm podcast, listen to that one. The Truth Behind the Market Moves, listen to that one. That one is killer. You're going to really love it. And then this one here, this is the Think Like a Business Owner, Not a Trader. All right, that's the one we talked about today in class. So that was the whole thing there. Now these are all really good, and they're all really fun, and she's got some personal ones in there. So go and support Claire and listen to her little, because she looks at how many people listen to her podcast like it's her lifeline. I got one more person listen. She's so happy when one person listens. All right, so go listen to her podcast. She works hard on them. All right. And get yourself Pitt News Magazine. If you don't have Pitt News Magazine, well, my goodness sakes, what can we say about that?
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
I know. I left my microphone off. But you got the point, even with my microphone off. Come over here. This is where you go to Claire, and the ones I want you to look at are these down here. Those are, I was pointing to them. I'll point to them one more time because I'm stupid, left my microphone off. I got to stop doing that. Okay. So we'll go to the very bottom. This one here, BlackRock Algorithm. I really want you to watch that one. All right. I really want you to watch this one. And then I would really want you to watch this one here. The Truth, they're not videos. You don't listen to them. You don't watch them. You listen to them. The Truth Behind Market Moves. Really want you to watch that one. Okay. That one. And then Think Like a Business Owner, Not a Trader. That one. You got to really be thinking. You got to do that one. That's a really super important one. All right. So that's Pitt News on air. Claire works really hard on those, and she loves it when she sees people watching them. So go and watch those. But they're really helpful. It's what we talked about today in class. And of course, make sure that you subscribe to Pitt News Magazine. Everybody's got to have Pitt News Magazine.
Look, if you haven't subscribed to Pitt News Magazine yet, then I'm going to need to see you professionally because you must have something wrong with your brain.
All right. I guess my microphone was working. So it just shuts me off when I run a video. Okay. So that worked. Okay. So we're back to business. Let's go over and I'm going to show you how to do these cones of probability. Now, this is where, see this little cone right here that I've drawn in here? This is where I think the market's going to go. It's going to stay in that cone until we get a break. And this is the third drive pattern. People in the news, that's why I want you to go watch that article on Pitt News Magazine, or listen to that news about the news, that podcast on the news, because it's really important to understand how the news affects the markets. All right. So let's go ahead and we're going to clear all this off, and then we're going to do it again so you guys can do it. And you can do it on not just this market, obviously. This is for every stock. Yeah, every stock you're going to trade, you can do some sort of a Fibonacci projection. Now, those of you who have been in my class, you know that those of you that are new, a lot of this is going to go over your head, but that's okay. It's your first day in class. You don't become an expert after one day. So we know that this is drive 1, drive 2, drive 3. This is an Elliott wave pattern. It's classic. All right, classic Elliott wave. And then a classic Elliott wave generally has an ABC pattern like that. All right. And then we use a Fibonacci ruler to measure from the low to the high of the Elliott wave down to find out where the delta cone of probability is, which is where we anticipate the market coming to. So we have also Fibonacci bow ties. Now, Fibonacci bow tie is something that tells you that a market has a tendency to rise in price and then pull back to previous levels of resistance, right? So of support. So support becomes resistance, or resistance becomes support, depending on which way you're looking at it. So right here, this is the previous high. This is a previous high on these different legs. All right. So I'm going to take this Fibonacci ruler off because that's the delta cone of probability. This is where, traditionally speaking, we expect the market to come to. I don't think the S&P is going to fall that far. Doesn't mean it can't. Certainly can. It's in the math. The mathematical models say we could bring the market all the way down to here. That would be one, what we call Darvas box. One Elliott wave is a Darvas box. All right. So the full Elliott wave from start to end, which would be the ABC pattern, is one Darvas box. And then we would expect the next Darvas box, wherever it ends, like right in here, to start right there. So the next Darvas box would be as we turn and start to rally and start our next 3 drive pattern up in a bull market, right? In a bull market, we would bring our next Darvas box from the beginning point here, and we would anticipate another 3 drive pattern, and that's why you get a bull market, because you get 3 up and 2 down. So it's slow grinding higher. We're going to make 3 up, 2 down, 3 up, 2 down, 3 up, 2 down. That's a bull market. In a bear market, it'd be the other way around. It'd be 3 down, 2 up, 3 down, 2 up, 3 down, 2 up. Now, is it always 3 down, 2 up? No, it's not perfect. It's just statistically speaking. All right. That's how the market moves. Statistically speaking. Right? There's lies, damn lies, and statistics. So we just have to be mindful that this is not a perfect setup, but it works often enough that we can count on it and we can put money on it. And as long as it's somewhere close to that, we can figure it out in hindsight and figure out where we're at and where we're going to be putting money. And so we go through our accumulation and distribution. So we accumulate, buy low, and we sell out as markets go up. So we sell high. So buy low, sell high. And then as markets start to come down, we start to accumulate, we start to buy low, buy low, buy low, and then we don't know where it's going to turn. So we can do a little bit of dollar cost averaging as it gets down into regions where we think that we're going to start turning around, and we don't just back the truck up all at once. We do a little at a time, and we do a little dollar cost averaging. We get our money in there. And as it starts to go back up through that Darvas box, all right, but we want to know where the probabilities are for these markets. So we use mathematical probability projection tools, and that's where Fibonacci comes in. And you're like, what makes this work? Well, the reason it works is because this is how the big quant systems, right, the BlackRock systems, the Aladdin systems, which is why I want you to go watch that podcast. The BlackRock Aladdin systems, this is how they do their business, this is how they run their algorithms. So we're trying to reverse engineer their algorithms, figure out where they're buying and selling, because that's what they do. They buy low, sell high. We want to do basically the same thing. Now, we can't do it the way they do it because they got such deep pockets. So we have to do it on a smaller scale. But we can use whatever strategy we want once we understand the concept of where the markets generally go. All right. So to get this 3-drive pattern, we go back to the previous trend and we start making projections just as we would on the smaller level. So if we come into a smaller level and we do a little tiny projection like this, right, and it measures that little bow tie in there, well, what if we were to go use a bigger bow tie? All right, a bigger bow tie. So what if this was our bow tie right here? So this right here, we go from this high to this low all the way up to here. Now that's a big bow tie, right? So if that's a big bow tie, well, that's what it is. They're fractal. Little bow ties turn into big bow ties. So what we've got is we got a bow tie that's come in here. Now, generally speaking, we like to see bow ties be symmetrical, right? And those of you who have been in my classes, you know, we've talked about this a lot. So a market can have a bow tie come down like this, and we like it to go up double the amount. So that would be a perfect bow tie. Does it happen perfectly? No, not very often. Doesn't mean it can't, and we like to see it when it does, but it's not usually perfect. That would be a perfect bow tie. And what a perfect bow tie would be was that from this previous high, which is right here, right, to this dip down here, which in this case, because we're doing this whole big long thing, not just these little tiny bow ties, we're doing big bow tie. So the big bow tie, that's this point right here, is this point right here. So this one has driven all the way up here above the previous high. So a perfect bow tie, we like to see make its 3-drive pattern, the distance from there to there be the same. It's called the reflection, right? That's a strategy built by Wells Wilder, and you can go read it in his book. All right, it's called the reflection strategy, and this is where this idea, this concept comes from, because Wells Wilder noticed this in the markets. Wells Wilder is the one who created the RSI. He's the one who created the parabolic SAR. Wells Wilder is the one that created those blue lights right there. That's why this whole structure is built mostly around Elliott Wave Wells Wilder strategy. I didn't make this stuff up. I learned it at the Chicago Board of Trade when I was there. All right. At the Temple of Doom. I mean, the Temple of Finance. All right. So we anticipate that this is, and the same guys who were there sitting in those classes with me when I learned this stuff, they went off to Wall Street and they built the mathematical trading systems for Wall Street that they use. That's why this is important. People are like, why are you teaching me all this stupid stuff, all this math stuff, all that Fibonacci stuff? Because I learned it at the Chicago Board of Trade when I was a young man. And what did I do with the knowledge? Well, I took that knowledge and came and created a software company, created this tool right here on the screen, what you're seeing, this software program. I created this program. So when I left school, when you graduated from college, what did you do? Well, I went and worked for a company. Okay. And you did your business, right? Or when you left college, what did you do? Well, I started a business. I started a startup and I did this. Well, that's what I did. I went to school. I went to school at the Chicago Board of Trade. I mean, that's not really why I was there to take school, but I treated it like I did because I was dumb. And so I just sat in all the classes. I was there for free. They were paying me to be there. You know, I mean, or I got paid to be there. Chicago Board of Trade didn't pay me. I was there as a teacher at the education center as a guest. So I would come in and I would teach, but when I was done teaching people how to use a mouse, right? That's what I was there for. I was to teach people teach them how to, then I went and sat in all the classes. That's how I learned all this stuff. I went and sat in all the classes and I took all the classes that they were paying $2,000-$3,000 to be in, and I got to be in there for free. So I got a free education at the Board of Trade. It took me 10 years to get in all these classes. After 10 years of doing this back there, I go back there all the time and I'd go to all these classes. And I learned all this stuff. And what did I do with the knowledge? I started a company. I started a little startup and I started selling software, and I've done had a pretty good living doing it with my startup from the knowledge what did those guys do? Well, they took that same knowledge that I'm teaching you right now. They went to Wall Street and they built trading systems for hedge funds. They built quant systems for hedge funds. That's what they did with the same knowledge. That's why this stuff that I'm teaching you works, because the guys who are in my class are the ones who are trading this stuff with computers back in New York. And I started my little startup to help you guys understand that that's what they're doing. That's where this comes from. I didn't make this up. I didn't pull it out of my hiney. I went and got this information at the Temple of Finance in Chicago. And I'm teaching it to you because this is how they were taught to make their quant systems. And this is what the market runs on. These great big quant systems control the markets now. Everything is done with computers. All the big trading is all done with computers. And I'm teaching you the mathematical formulas that they were given to trade the markets with, and that's what they wrote their quant systems on. So if you want to know how they trade, I'm telling you, this is how they made their quant systems. And that's why the markets do what they do. Now, there's a caveat to this. The markets don't work perfectly because there's retail traders. So you got the quant systems, all the mathematical formulas that would work perfectly if they could, but they can't. It wouldn't work well if they did anyway. You need the retail traders out there, the people who are giving the quant systems all their money. That's really what's happening. The quant systems are just taking the retail traders' money. You go work at McDonald's, you put your money into the markets, quant system comes and takes it from you. That's why you lose money. All right. So the systems that they use to take your money are these systems that I'm teaching you. So if you understand what they do to take your money, well, hopefully you can be smart enough not to let them take your money. And one of the systems is this little model right here. One of the most important things that I can teach you is this little model right here. This model is on the cover of my book. All right. It's on the cover of my book. Your book? Yeah, I wrote all this stuff down for you. It's in a book on Amazon. So if you go out to Amazon and search Lan H. Turner, all the stuff I learned at the Chicago Board of Trade, I wrote down in a book, and it's out there for like $30. I just like basically give it away to you for free again. Amazon takes all the profit, not me. I don't make anything on that stupid book. If you don't want it, I don't care if you don't want it. I don't make any money if you buy it. It's not like I'm out here pitching a book. I'm trying to help you guys make money. All right. This is the model that you need to understand. And so this model right here is what we're reproducing in the market. And it's fractal, meaning that it does little ones and big ones. All right. And so when you understand this whole concept and you put it all together with the accumulation, the distribution, the chalk and money flow, you understand the Fibonacci, the delta cones of probability, and all this stuff, this little, and it's not hard. If you just stick here with me, you can learn it. That's how Wall Street creates their quant systems, and I'll teach it to you so you can understand what's going on so you can play against it. And so you're not just the retail trader that's giving all the quants your money. You're smart enough to take some of the money away from the quant, or at least do what they do so you can take money from other retail traders. That's really what you're doing. You're not going to take any money from the quants. You're going to take money from other retail traders like they do. That's what your goal is. All right. For every winner, there's a loser. You want to be on the winning side. It's basically the 80-20 rule for traders. 80% of traders lose money. 20% make money. You want to be part of that 20%er? Well, you got to learn how to take money from the other 80%. And this is how you do it. All right. Now, so this is one great big long bow tie coming back to the previous high. That's why previous highs are so important. People are always talking about, oh, it broke the previous high. Okay. Well, why is that important? Because that is this model right here. It's on the cover of my book. All right. Actually, I don't think it's on the cover of the new book. It's on the cover of the digital version, I think. I think that I replaced the cover. I don't remember if it's still there. No, I think I put chess pieces. So make sure you're getting the one with the chess pieces. That's the new version. All right. So this is coming down. It is on the cover. It's on the cover of the one I give away for the supplement that I use here in class. All right. Anyway, this is our our perfect model, right? But we're not getting a perfect model right now. We've already gone through 3 drives. We're up to the second drive. The third drive is the only one that's popping above the previous high at this point. So we're not getting a perfect. If you were to take this projection, right, and you were going to say, okay, we're going to expect this and this, because this market was kind of a wacky market. So it would be like this, wouldn't it? We would come in here, and you can probably do this on a weekly chart or a monthly chart a little better, but we're going to do it on the daily chart. So we're going to come in here, and you can see that we would expect this thing to go the same distance to make a perfect bow tie. So you could make a projection up like that. That would be a perfect bow tie, but that seems a little ridiculous, doesn't it? It does. But what we're going to do is we're not going to take that, because what happens is you end up with your bow tie, and you don't have a perfect bow tie oftentimes, right? Because the market's not got enough strength to go full bow tie. So what we do is we come in here, and we end up with a little bow tie. So let me clean this up, and I'll show you. And a lot of you have seen me do this. We get these little wimpy bow ties where this one doesn't go up very high, right? And we get a little wimpy bow tie where it just breaks above. It just breaks above and barely makes it. It doesn't go up for a full bow tie. So we got to take that into consideration. That's why it's important to count the 3 drive pattern. Kirk's saying the one out on the has the chess pieces. All right, so I think it's this one here, Kirk, that I have the. We'll pull it up and show you. It's pitnews.com/slides. Yeah, I just give this one away for free because this is the supplement to the book that's out on Amazon. See, right there, look at that. Right on the front cover, Fibonacci, Beyond Fibonacci, Decision Point Trading and Insights. And there it is. There's your Fibonacci bow tie right on the cover. All right. So it's just on the cover of the supplement, not on the cover of the main magazine. All right. So here we go. So this is what happens is this bow tie doesn't always perform admirably. Should we put it that way? It doesn't always perform admirably. So we generally watch the 3 drive pattern. So we get a drive 1, drive 2, drive 3. And then where this comes out, we generally want to see that thing perform admirably. Now, we're not seeing this perform that way. I think we're going to see a pullback off the 3 drive pattern, which on this particular situation, the bow tie barely breaking above the previous high. We're going to get a wimpy bow tie, I think. I think this is going to be a little wimpy bow tie, which would be okay. I mean, this has been a massive run up. So if we get a little pullback and then we can start a new Darvis box. Okay, that's what we want to see happen. So how do we make a projection of where we think this thing's going? We're going to use the bow tie tool to help project the downside off of this. We're going to start by going off of the first A point, right? The highest point, the previous high. You go to the previous low, and then you go up to the top of this one. Now, you can put this at any point along the trend, but always be mindful that the 3rd drive is generally the top. Doesn't mean it has to be. It can go to 4, 5, 6, 7, 8, 9, 10. It certainly can. It's just the probabilities tell us the 3rd drive. Now, the reason I bring that up is because when we looked at the Q, look, we're only at the 2 drives. What does that mean? Where those don't match up, we like them to be porpoises, right? We like them to do the same thing. So is this thing going to flush at this point and come down after only 2 drives? Could. We don't know. Could it go up and make a 3rd drive? Probably not if the S&P doesn't. That's the shy. Let's go back here. If the S&P doesn't, that would be the S&P would have to go drive up to a 3rd drive or 4th drive, which could happen. I mean, because the Qs very much are extremely strong and represented in the S&P 500. We're only at the top of the 2nd drive. We could get a 3rd drive out of this thing. Come down here, and then we get that 3rd drive. So keep that in mind. All right. We're working off the S&P. You have to think about them as a family. All right. It's a family reunion here. Now, we're going to come in and we're going to do our ABC projection. And this is the downside potential back to the Fibonacci sweet spot, right? Which is right now, I've got it drawn in there with the Fibonacci ruler. I've drawn in there with the Donchian channels. So that's bringing us back to this point here. And that's why you can see 50, 60%, and you get what we call a Fibonacci cluster, right? A cluster of Fibonacci numbers. And when you see a high cluster of Fibonacci numbers, that's generally a pretty good area of support or resistance. There's going to be a lot of quant systems that see that. It's been programmed into it. And so there are different variations of their models, and they're going to all conglomerate into one place. So you're going to see that. That's why Fibonacci clusters are important. All right, because different quant systems are programmed to see different numbers, but as when you get a conglomeration of a whole bunch of Fibonacci numbers in the same spot, that means all these different quant systems are going to see that area as important. All right, so what we're going to do is we're going to come in, we're going to draw another Fibonacci bow tie tool. We're going to take our second one, and instead of putting it from this high, we're going to put it from the previous high, which is right here, and we're going to go to the same pivot point right here. This is really important that we put it on the same pivot point at the bottom and at the top. All right, so now we're starting to form ourselves what we call a Fibonacci cone of delta cone of probability, or Fibonacci cone of probability. So now we're starting to see that this is where we're going to think the market's going to go, right? And sometimes it's more prevalent, sometimes it's less prevalent. But if you, it's backwards. We're going to go here, back to the top, and then back down here. Okay, so that becomes our delta cone of probability. Now, if you were to delete these things, right, that would be your projection of where kind of the market's path of where we'd think it would go on its retracement. Doesn't mean it has to go down it perfectly, but you're going to be surprised when you do this how often the market goes right down that little trend. Is it going to go down this time? We don't know. It's just barely starting. It might turn and go up and make another fourth drive. You know, the markets are really strong. We're in that Trump train, and all that money's coming in from all of the tariffs and everything, that we may not get a big pullback. But we're looking for one. We want to have a pullback. I got a whole bunch of cash sitting on the sidelines because I've been taking profits all along the way, right? And I want to get it back in there. I want to buy more machines. I want to compound my money. So I'm waiting to put some more money back in there, so we can come in and do one more. And that's why you saw me have a whole bunch of lines on the screen in the beginning, because I was going back because we had like a triple top here. So if you go back to this next top up in here, you end up with another delta cone of probability, all right, because this thing went sideways, which means this market could easily go sideways, right? It could easily just kind of go sideways. So there, that broadens our cone of probability out because of that historical sideways market. You're like, well, what does that market have to do with this market? Nothing, other than the fact that the quant systems take it into consideration and put it into their mathematical models. That is why that historical data is important to the current market going forward, because that's how quant systems are going to trade it. All right, based on history. They do all their mathematical projections based on what the market's done in the past, and that's what they trade. So that's why it's important. You're like, it has nothing to do with it. It's not important. Not fundamentally, it's not. And you're right. So the fundamentals can screw up the technicals for sure, but the technicals are generally just used for our entry points, right? We use the technicals for entry points. You can love the fundamentals all you want, but if you get in at the wrong spot, you still get smoked, right? You can still get smoked. Yeah, that. Oh my goodness. Another story pops into my head. I just don't have time to tell it. Sorry. Another wonderful story. Land's full of stories. All right, let's just do one more just for fun. So here's what I was doing, and that's why there's so many lines in here. Wrong one. That's not the tool I wanted. The Fibonacci tool. Here we go. So we're going to go back one more just for kicks and variety. All right. And we're going to go, it's off the screen. So let's go put it, scoot the screen over. And we got to put it on the same place, the same pivot points. Okay. So it just broadens out our cone of probability. So that ends up being our cone of probability. Now, the other thing that's important to remember is that there's already a mathematically calculated cone of probability that was created and invented by a guy called Gann. Some of you have heard of Gann, the Gann fan. All right. So if you take the Gann fan and you put that in here and you draw it down, you hold down your control key while you're drawing the Gann fan in track and trade, and it gives you a delta cone of probability. That's what Gann is. Did you know that? Gann gives you a delta cone of probability, which, how can we do that? We come in here and let's change our delta cone of probability for the Gann fan. Let's make it, what's a good color? Pretty color. Green. Let's make it green. So this one, we're going to make it lawn green. So we're going to come in here, and this delta cone of probability, we got to go this way, is based on the 1 by 2. So anything between 1 by 2, we're going to go here, here, here. That's Gann's delta cone of probability. All right. So there's Gann's cone of probability. And this one here, the blue one, is the Fibonacci cone of probability. Can you see the difference between the two? So we got the Fibonacci cone of probability, and you saw how I calculate that one. Gann just goes off the high point, and you do the control key, and it does what we call square the Gann fan. So it squares the Gann fan by holding down the control key. You can take a Gann fan, and you can just draw it however you want. It kind of goes like this, but you don't want it to do that. You want it to square. So hold down your control key when you draw it, and it will square it to the current market settings scaling. And then you can lay that over your chart, and you get a delta cone of probability. Now, like this is the Gann cone of probability. All right. So, but the between 2 to 1, as long as it's between 2 to 1, that's a good solid scan. If it goes above 2 to 1 on the downtrend, it's the same thing on the uptrend. If you do one for the upside, you can get the same thing going for a bull market like this. It gives you a delta cone of probability of where the market's going to go. So as long as the market stays inside the cone, Lan, you can't draw these things. I never can draw these things. There we go. Okay, that's the uptrend. Now, if it goes up above the delta cone or the Gann cone, if it goes up into this region here, it's going up too far too fast. It's going up too fast, and it's bound to fall back down into the cone. If it comes down below the cone, it's bound to go back up into it, all right? Or you're going to get a reversal, and it's going to continue down, and you're going to have to take your down band and do it like this. And then you're going to get your down cone off of the previous high, all right? So that's sometimes you'll see pictures of Gann fans laid over the top of each other, and the screen just looks like a mess. But when you understand all they're doing is they're measuring the Gann cone of probability up, and then wherever that peak gets to, they turn the cone upside down, and then they're measuring the Gann cone going back down. But because they got the overextended on both and the underextended lines going out both sides, it looks like a mess. And you're like, well, how is that helpful? Well, they should probably get rid of some of the other older Gann fans, but they want to take a picture of it and show you on the screen so it makes them look cool. All we're really doing is we're trying to look for those Gann cones of probability. All right. So that's what that is. And that's how Gann works. That's how the Gann fan works. So now in this case, we've laid the Fibonacci cone of probability out over the top of the Gann cone of probability, and both of them overlap. You can see how they overlap. So that is the overlap. Let's send back. So there's your overlap of those cones of probability. Let's send this one to the back. It looked better that way. Now it's, I don't know what's going on. Get rid of this one. There we go. All right. So that's your cone of probability of where the projections are saying this market should go if it makes an ABCD retracement right down through that cone of probability somewhere. All right. Back to the 50, 61% region. Is this market going to do that? I don't know. Nobody knows. It's just what the mathematical models are saying, that this is at least where we didn't want to be buyers for certain. Didn't want to be buyers right here. We want to get a nice little pullback down in here so we can buy the valley. Now, everybody's freaking out. I mean, everybody's just going ape shit, blaming everybody, everybody's fault. It's not a fault of anybody. It just means that the mathematical quant systems hit a take profits zone. The mathematical quants on Wall Street said, we just hit a target to take profits. That's all it is. That's what's happening. So don't freak out when the market pulls back. It's got to pull back. They got to take their profits. It's accumulation distribution. If they don't accumulate and distribute, they can't trade. They're the market makers. They make the markets. The markets go up and down. That's how you make money. Buy low, sell high. And if those quant systems are not producing and making their accumulation distribution models, you can't trade. Markets go through waves. That's what they do. All right. You can count the waves. You can measure them. And you can predict them the very best you can, and project and predict. That's what we want to do. Count, measure, set up, trigger, and follow through. Project and predict, and then place your orders. All right. Wait until the odds are in your favor. You want to bring the odds in your favor to the highest levels you possibly can, and that's how we do it. Try to predict what the quant systems are going to do. And I'm here to teach you what the quant systems, how they were programmed, so that you guys can do your best work at trying to predict where the markets are going. Now, if you're not good at this type of trading and you don't want to do it, don't do it. Go out and work, get a job. You don't have to do this. And then take the money that you make and put it into these other systems. Go start a business in the financial markets so that you can make money this way. But it takes money to make money. If you don't have money, you can't start a business. You got to have money to start a business. So the way we make money is we go trade. This is the way we make money. If you're not good at making money this way, don't do this, because you can lose money doing this too, right? Not that you can't lose money over here, but it's not that you can. It's just, from my experience, it's less likely that you're going to lose your money over here, all right, than you are over here. A lot more likely that you're going to lose your money over here, because this market was designed for you to lose money, because you're a retail trader. And these quant systems were designed to take your money. That's what they do. They take your money. That's how they make money, it's by taking your money, because it's the only money that they don't have is your money. So they got to take your money to make money. And they're pretty darn good at making money. And so if they make money, it's because you lost money. So if you're not good at this, don't do this. Go work, get a job, and then come back and do this instead. All right, then let me help you set up your, I just want to go down and grab all the little friends at the coffee shop and shake them. Say, look, I can help you. And you're here, and I appreciate that. So I'm here to help you. Let's make this happen for you guys too. All right, because this is real money. This is real money. This is my real money account. And I'm telling you, I'm making about $26,000, $27,000, $30,000 a month doing this. And I started with $476,000. $30,000 in July. Made $30,000 last month in July. And I started 1 year ago with $476,000. And last month I made $30,000. Look, in May I made $53,000. It's been pretty consistent. 31, 26, 27, 30. That one was amazing. 53, 31, 30. I already made $7,000 so far this month. I've only had 3 payoffs. All right, guys, that's enough. I have said everything I have to say today. Hopefully this is helpful. Hopefully you guys are enjoying the class. Hopefully you're learning something, and hopefully you guys are making money too. And if you would like additional insights, pick up Pit News Magazine. And the software course I use to trade with is...
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's it, guys. We will catch you tomorrow afternoon at 1 o'clock. We're going to play with day trading, because a lot of people like to do day trading to earn their money to put into these accounts, right? There's lots of different ways to make money. One of them is day trading, and we're going to do that tomorrow afternoon, and I'll show you my little strategies. And we're going to automate the golden strategy. We're going to run that again. We'll do a little bit of scalp and trail. All right. We're to be in the futures market. We should do some longer term trading in the futures market. I know the guys keep telling me that, but I only have 1 hour. I can't do, we can set up some long-term trades. Maybe we'll try and do a little of both. All right. We'll do a little bit of both tomorrow. We'll do a little bit of long-term trading in the futures market, because you can certainly do that. I have many students who trade the futures market longer term basis. It's not all scalping. It just happens to be what we do, because we do it here on YouTube and it's fun, and that's a good place to go day trading. People like to learn day trading. So we'll do a little bit of longer term trading. I got one student who makes thousands of dollars just trading corn, and he trades it long periods of time, right? He doesn't day trade it. So we can go and I can show you some of those strategies too. It's very similar to what we do in the stock market, right? Buy and hold, but on a shorter term basis, buy low, sell high. We can just do it in the futures market, where it doesn't take a huge investment. We do it with a smaller amount of money to get started. All right. So we'll do that tomorrow afternoon, power hour at 1 o'clock Mountain Standard Time. We'll see you tomorrow afternoon. Take care.
All right, That wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah! Definitely subscribe to Pitt News Magazine. You'll thank us later.